This is the European edition of Breaking Banks, the world's #1 fintech podcast and radio show. We bring you the European unicorns, startups, founders, regulators, and leaders innovating the rapidly evolving fintech scene today. A truly localized podcast with both English and local language content, with some of the world's most well-known hosts and influencers in the fintech sector globally. Join us every week as we explore what makes the European Union a phenomenal proving ground for many of the fastest growing fintech plays in the world today. Okay, let's roll.
Hello world, I am Paolo Sironi, your host for the Banker's Bookshelf, a new show of Breaking Banks Europe that is part of the Breaking Banks podcast family, the most followed fintech podcast in the world. The Banker's Bookshelf is our collective moment of critical thinking inspired by authors and researchers of the most interesting books, papers, and publications, which are finding their space in the libraries of curious bankers and fintech entrepreneurs. In each episode, I will invite authors and researchers to share views that challenge the status quo and common assumptions in financial services. They challenge business culture and technology expectations to help us understand the banking present and its fintech future. With that, we can all make better informed business decisions. And I have the pleasure today to have in our first episode of the Banker's Bookshelf, Sangeet Choudary. Sangeet is the founder of Platformation Labs and the best-selling author of Platform Revolution and Platform Scale. He has advised the leadership of more than 40 of the Fortune 500 firms. His work on platforms has been selected by Harvard Business Review as one of the top 10 ideas in strategy, alongside Michael Porter, Clayton Christensen, and others. Sangeet is a member of the World Economic Forum's Global Future Council, an entrepreneur in residence at INSEAD Business School, and the youngest ever recipient of the IIMB Distinguished Alumnus Award. Sangeet is a frequent keynote speaker at leading global forums, including the G20 Summit, the World 50 Summit, the United Nations, the World Economic Forum, and of course, the Banker's Bookshelf. Sangeet, welcome to the show.
Thank you, Paolo. Pleasure to be here.
Sangeet, I'm super excited that you're joining me for the first show of the Banker's Bookshelf. And what we want to do is we started talking about Platform Revolution. You're an amazing bestseller. I've been reading it many times and I have a lot of annotations, but I know that you're also currently working on a new book with a launch expected next year, but anyone in the audience can join me and thousands more to watch you building it in public at platforms.substack.com starting April 2024. Now, let me share with the audience more or less what I got out of your literature and research starting from Platform Revolution. I just highlight some concepts and then we deep dive into the conversation so that you can explain yourself in your own words, your research and amazing thinking. Key to your stories is often the concept of unbundling and rebundling. Now, most disruption in fintech happens through unbundling banks, but most venture returns are realized through rebundling because digital technologies collapse transaction costs. Now, rebundling involves bundling multiple unbundled capabilities into a cohesive, customer-centric offering. For example, venture capital chase unbundling because unbundlers hold the promise of rebundling and capturing value. However, in the end, most venture money is lost because only a handful of the fintech rebundle. It's easier to break than to rebuild. Square, Plaid, Stripe are a few of the unbundling fintechs in payment that successfully rebundled and now dominate one or more horizontal layers in the value chain. Now, you can now explain to us your research and ideas in greater details, and also addressing how established organizations like banks can thrive in the age of platform-driven innovation, thinking also about your next, which is sandwich economics. Sangeet, first question to you. I'm really curious to know, how has your own journey of inquiry led to platform strategy first, and then to formulating the idea of sandwich economics? Then we discuss what it is about.
Absolutely, Paolo. So a lot of the ideas around unbundling and rebundling that I've kind of built out has been a natural consequence of trying to understand the first principles of how the platform economy works. And my journey in this direction has had multiple phases. I started initially by trying to understand how our business model is fundamentally changing. I started my career with big tech firms, Yahoo and Intuit. Both of them were trying to figure out how the internet changes business models, and they did not quite get it right because Yahoo thought of the internet as a media business, and Intuit thought of it as a place to host software. And I felt there was something much bigger. And that's where I formulated the idea of we're moving from a world of pipelines, which are linear business models. You build something, you push it out to the consumer, and you charge for it, to a world of platforms where you do not just push value out, you create an infrastructure, set the rules of governance, and bring the stakeholders together to interact and coordinate value creation with each other. So my initial foray into explaining platforms was driven by a natural desire to explain how business models were changing because of the internet. Now, once that gained traction, a lot of work that started coming my way started looking at the inordinate growing power of platforms. So, a second phase of work that I did was increasingly around explaining under what conditions do platforms gain power? Under what conditions does market power concentrate with a few firms? And that's where I started then breaking this down into really thinking about the core factors at work in the digital economy. Whether you're building a platform or you're building some other business model, there are two fundamental factors that are constantly at play in the digital economy, even more so than they were in the traditional economy. And that's the idea of unbundling and rebundling. So the section that you just shared about where I talked about, unbundling disrupts the status quo and rebundling delivers venture returns. I actually formulated dove deep into that particular framing because over the last 10 years, we've seen a lot of banks trying to copy fintechs. They've sort of had a fear of missing out. The technology is shifting. Fintechs are doing something which is taking away our business. And repeatedly, I had to explain over there that, well, unbundling, which is what fintechs are doing, does not necessarily create and capture value. It disrupts the status quo. It definitely creates value for the consumer because you're no longer restricted to the traditional bundle, but it does not create a vehicle for value capture. In order to do that, you need to have a key control point in this unbundled scenario, and then you need to rebundle around that control point. A very simple way to think about it, forget financial services, a very simple way to think about it is in how we think about it in terms of content and media, because we use content as a consumer. So the traditional bundle used to be, for example, an album. If you want to listen to music, you would buy an album from a musician. And then the internet unbundled it. You could start sharing individual files and file sharing services. And then Apple tried to create a business model around it with iTunes. But eventually, we've reached a place where the business model is now around rebundling as Spotify playlists. So playlists are user-centered rebundles of this unbundled music treasure trove that's been created because of the internet. Or think of traditional news papers as bundles of news articles. They got unbundled with the internet and got rebundled in the Facebook news feed and many other news feeds that we have today, which are again rebundled around the consumer. So traditional bundles in the industrial economy used to be bundled around production processes, and the same thing happens with banks. Rebundling happens around consumer interests. And what's scarce in the consumer in the digital economy is consumer attention, and that's the locus of rebundling.
So, Sangeet, I hear you well, and that resonates extremely well with me. I have to say, we are on Breaking Banks podcast, and I've been meeting thousands of fintechs worldwide, and I always told them you can't break banks because they're already broken, in the sense that they are divided into different business units that don't really talk client centricity. So the rebundling aspect is the important one, but rebundling doesn't mean that you're the same, just like better connected. Things change, and things change also in the structure of the economy, which is I guess the concept of sandwich economics. Now, can you now link platform and sandwich economics to introduce this new concept you're working on that I find extremely fascinating?
Absolutely. I think, my work on sandwich economics has been a convergence of how do platforms create value, how does power get created in the digital economy, and how does unbundling and rebundling shape the digital economy. So the way I see this is that because of these simultaneous forces of unbundling and rebundling, we are increasingly seeing most value getting concentrated at certain layers of the value chain. And there are 3 or 4 specific layers at which value increasingly gets concentrated. The rest of the value chain increasingly gets sandwiched between these layers. If I take a simple example, if you think of Amazon, Amazon has a core infrastructure layer in terms of Amazon logistics and warehousing, which sellers use to run their business and do their fulfillment. And then it has the marketplace layer and Amazon Prime, which is the world's largest membership club, where users are, get 2-day delivery and so continue shopping on Amazon. And so between these 2 layers, the sellers are increasingly sandwiched. If you look at Amazon's average take rate over the last 5 years, it's grown from 15% to 50%, because it's constantly increasingly sandwiched the sellers and taken more of their profits through a combination of increasing advertising fees in addition to just the marketplace fees, and through a combination of enforcing them to use Amazon logistics if they want to sell through Amazon Prime. So that's an example of essentially using dominant positions at multiple layers in the value chain to squeeze the rest of the value chain. And that's the idea of sandwich economics, the factors that lead to the creation of this structure.
So, Sanjay, I understand that the sandwiches are good for those who can buy them, and sharing between can be complicated. I'm sure that by the end of this conversation, we'll also explain how to mitigate all of these negative elements, right, to find the right balance. But first of all, do you find an example in financial services of those which are understanding this concept for the audience? When you go from vertical, you can imagine some like piles of Lego bricks, and then all of a sudden those Lego bricks gets detached, and then they reconnect vertically to build basically these layers that show some layers become more dominant than others to squeeze either in or out. So what about financial services?
Absolutely. I think in order to explain financial services, it's helpful if we understand how do these Lego bricks realign? How does the rebundling happen? And typically when unbundling happens, so if you take financial services as well, when unbundling happens and you start seeing the rise of specialized firms taking every single Lego brick and performing a specialist function, the coordination costs increase, because to do the same thing, you need to now work with many different specialized firms. And as fragmentation increases, as coordination cost increases, that's the point at which rebundling takes shape. So a starting example that I would take is a company like Stripe. What Stripe is doing is it's coordinating coordination costs across the entire payment services value chain. It's removing the fragmentation of having to integrate with many different types of payment services. It's creating a single point and an easy point of entry through which you can, work across all of these different Lego blocks, if you will. And if you look at Stripe, by using that initial control point, it is then able to expand into many other services around it. Today, in fact, Stripe is uniquely positioned as the owner of the merchant ID every time payments get processed. So it can actually uniquely identify who's driving a car on Lyft, but also running a shop on Shopify. And so Stripe, in a way, kind of owns that horizontal, not just rebundling at the level of solving the coordination cost, but also now owning the merchant ID across different platform businesses. So that's one example. there are two other places at which rebundling happens. One point of rebundling is closest to the customer. So if you look at most companies outside financial services, a lot of rebundling has happened closest to the customer. If you think of Amazon Prime, that's a point of rebundling close to the customer. If you think of Google Search, it's a point of rebundling close to the customer. So by owning a key consumer need and owning it in a dominant fashion, you are in a position to aggregate consumer demand, and that allows you to create a bottleneck towards serving that consumer demand. And that is why most financial service players today want to get into payments, because payments is one way you can fundamentally own a horizontal layer across the financial services value chain. A great way to think about this is also what happened in China with both WeChat Pay and Alipay kind of owning that layer close to the consumer. But if you think of Alipay before all the things over the last 4 years happened, Alipay also had really good infrastructural capabilities at the back end. So it had a layer of dominance close to the consumer in the form of payments, and combination of Alibaba Cloud and financials, various I would say risk scoring algorithms, credit scoring algorithms at the back end. So when Alibaba and financial initially tried to go global, what they did was they tried to take the sandwich and recreate it in different countries. And because they could not own the payments layer at the top, what they did was they invested in the top payments company, top digital wallet in every country that they entered in, on the condition that in exchange for the investment, that company would also move on to Alibaba Cloud. So that would then allow them to sandwich in each country that they were getting into. So those are ways to apply sandwich economics, where you actively think of how can I dominate multiple layers of the value chain and take over an industry through a combination of those factors.
Very fascinating. So basically, there are three layers: can be the infrastructure, the integration, and the aggregation. Companies can play a different game or multiple games according to these layers, but they need to succeed in all of them. The way they invest is different, thinking platform economies and sandwich economics, so it all changes. And why does this matter for our audience? We are on Breaking Banks Europe. The Bankers Bookshelf is a new series of this podcast, but we talk to the world. Now, European banks are some of the weakest in the world because of the protracted complexities of the macroeconomic conditions, like negative interest rates, very demanding regulation, and economies that are not performing as everybody would expect. And I remember Mario Draghi, the former chairman of the European Central Bank, 2 weeks before he left office, responding a question from a journalist about the role of central banks and the potential coming new systemic crisis. And what he said is that, of course, banks love positive interest rates, so favorable macroeconomic conditions around them. However, he goes, look at their cost-income ratio, is particularly way off. And he concludes, what banks have to do is to adjust their business models to the digitalization of financial services. When central bankers talk, every word matters. They don't say they have to digitalize existing business models. They say they have to change those business models to get the benefit of technology. Now, thinking platforms and thinking sandwich economics is essential to know how to adjust those business models to move forward. Otherwise, they will miss a huge boat. So the question becomes, can you help us understand what is a business model in this space? Now, more or less the strategy we depicted, but how can we envision these business models?
Yeah, I think one of the key things that banks or any traditional incumbent needs to think about is what are the potential points in their value chain that a horizontally dominant player can come in and work across them. So every time Apple Pay enters a new country, it creates competition among banks to start competing to work with Apple Pay. On the other hand, if you look at how banks worked in Sweden to create Swish in consortium with each other, they created that horizontal dominant layer and created a central position within that value chain. So if you think of any value chain, there are certain points at which you can start seeing horizontal dominance emerging. And so what you want to proactively think about is what are the points in the value chain where that kind of a horizontal play can emerge. Once that play starts emerging, do you want to proactively set up a preferential partnership position with it, or do you want to work with other banks to kind of disrupt the dominance that that particular play is happening. A very good example of that is what's happening with Plaid in the US right now. So Plaid has created a dominant position by working across banks, and now banks have come together to create alternatives to prevent Plaid from expanding across the value chain and hence sandwiching more and more profits away from them. So even if a platform player gains dominance at one layer, what you want to prevent from happening is preventing them from expanding to other layers of the value chain and then creating dominant layers at other layers as well. Because if you have multiple dominant layers, then you can start sandwiching the players in between. If you just have a single layer, you're still open to competition at other layers. And so the key inside of sandwich economics is that outsized market power accrues to platforms once they gain dominant positions at least two layers, possibly more. And then they use upward and downward pressure. Just imagine, for instance, you own the aggregator close to the consumer, so you own the consumer access, but you also own the industry infrastructure on which all the merchants are running their business, all the producers are creating their business. You can then absorb more of the critical production functionality, even more so with AI coming in. And at the same time, you can change conditions closer to the consumer so that your ability to control market access enables you to extract greater profits. And a classic example being how Amazon now not just takes marketplace fees, but also takes advertising fees. So it's the multiplicity of these dominant positions that allows you to sandwich. And that's the real factor that you want to avoid. And the ways to kind of for banks to fight against it is to either look for these positions before they firm up and try to set up a preferential partnership like a joint venture with such a position. And I can give a few different examples of how that plays out. B, it is for banks to come together in consortium if a dominant position has already been set up in the way that the leading banks in the US have come up and played. Or C, it is to kind of help regulators understand that if dominant positions stack up at multiple layers of the value chain, you're not necessarily just going to see the benefit of network effects for users. You're more likely also going to see the disadvantages of sandwiching and profits accruing to just the owner of those few layers.
So, Sangeet, what you basically said, if I can sum it up my way, is that whether bankers believe they are chicken or prime beef, they're all getting sandwiched. So they need to understand how to deal with that. And to deal with that, they need to open up more architectures and business perspectives, work with ecosystem and partners. They need to understand the sweet spot in the sandwich economy and start leveraging from that one. And there will be a variety of different ways of positioning for banks to do so. That also depends on regulation, the different markets, basically, they are working in. In my own literature, I discuss the emergence of contextual banking and conscious banking. That means how you embed yourself into different journeys. Some banks are actually trying to orchestrate those platform economies themselves, or you basically build advisory platforms where the value shifts from the product to the relationship and need to understand how to coordinate a complex ecosystem to be paid for the value that you have to generate. One key element that I always discuss with my audience is that the complexities of financial services is that mobile technology, which is where a lot of the platform economies are, if you like, realized in front of the consumer, is a technology of the demand. That means you go on Amazon not because you want to see what happens, you want to buy Sangeet book, and I will recommend to buy Platform Revolution and then stay tuned for the new book. But when people have to make more complex financial decisions, they need to talk to people, right? So the communication element becomes very important. Now, we are at the verge of a shift in the way we use technology in the domain of communication. Not everything is settled, but I'm thinking of generative AI or then AI in general. Now, you mentioned AI in the context of sandwich economics. I'm curious to know, where do you see the opportunity to use artificial intelligence in terms of interacting in a different way of seeing businesses emerge on sandwich economics?
Absolutely. I think the economics of AI are super fascinating, because what AI ends up doing is it commoditizes knowledge, it commoditizes predictions, and with that, what ends up happening is that you're able to democratize knowledge, you're able to democratize decision support, you're able to democratize the ability to make decisions across a much larger, much less sophisticated base of users. So, as an example, if you think of traditional relationship managers in wealth management, a wealth manager was fundamentally a bundle of a relationship and the knowledge that they brought to the game. And their ability to differentiate themselves was a combination of the two pieces. But if most of the knowledge can be absorbed into AI, and you can now empower a wider range of wealth managers to start working with AI, value will shift away from the knowledge, which becomes commoditized, to the relationship, to other layers that you can add into the relationship. And so value will increasingly accrue to the owners of the relationship. In any relationship-based business, in any value chain, there's a constant tension between relationship-based businesses and further upstream the IP and the product excellence. But if a lot of the knowledge can be commoditized, the relationship-based businesses can one of two things can happen. If you have a lot of very strong relationships, value accrues more in your direction. However, if you were largely operating with a highly fragmented network of relationship managers, you can now expand it even further, and value accrues back to the product. So value can accrue in both directions. I'll give two different examples over here. So think of a company like McKinsey, for instance. It's consulting firm. A lot of people say that with Gen AI coming in, consulting firms are going to lose value because AI can do a lot of the consulting. What they miss is that consulting is a bundle of knowledge services and relationship with the client. And the relationship with the client is the capital in consulting, because the relationship is owned by the partner. The knowledge services are provided by lower level consultants within the team. So as Gen AI commoditizes the knowledge services, the value will accrue even more to the relationship. And in a relationship-based business, the value in the relationship is primarily on guaranteeing the outcome. It's primarily on owning the liability. So especially with a technology like Gen AI, where you have issues, around variability of output because it's a probabilistic and not a deterministic, approach. In that kind of a scenario, the player who owns the liability and owns the relationship is in a position to capture outsized gains. So that's an example where the value accrues to the relationship. Versus if we now take a software provider, which has a reseller network. Traditionally, reseller networks have local advantages. They have, they have training advantages. They learn over time, and once they've built a training infrastructure internally, they are able to better sell your software. But if all of the training can be collapsed into AI, anybody can be a reseller, and so the value again shifts away from the reseller themselves who have absorbed the training, and moves in the direction of the product, which provides that training at scale in the form of AI to anybody who comes on board. So the reseller gets commoditized. So it can play out both ways. It's really a question of, what gets commoditized and where does value set once AI comes into the picture.
So three words I take from your explanation: value, commoditization, and knowledge. First of all, I always say if we do not identify value correctly, we cannot digitalize value. In my banks and fintech or platform economies, I look at two different strategies that lead to different business models. There is contextual banking, conscious banking. They are meant to eliminate the friction of things that get commoditized. Definition: contextual banking is what? Is the need to eliminate friction in ecosystems that make banking contextualized, that means embedded, into different journeys. So you need to learn how to participate on a new value stack that moves from vertical to horizontal on established economics. And the knowledge piece is about conscious banking, because is the need to demonstrate value. Therefore, to eliminate the knowledge friction, helping people to make decisions, that makes banking conscious of platform economies. That means transparent in the way they deal with clients, because value has to be demonstrated and remunerated in different terms. So from there, everything changes in the way the institutions, the financial institutions, leverage technology and things like AI to talk to consumers, to enable advisors to demonstrate that value in a dynamic that is different from the existing linear value chain that they've been working on. Now, you are one of the most respected voices also at the World Economic Forum. And at the VEF 2024, I had the chance of working on a piece of research with Christian Keller, the chief economist of Barclays, that we launched as Barclays and the IBM Institute for Business Value Research, that is on AI and productivity. So what we try to answer is a very compelling questions for economists. That is AI going to add productivity growth on economies, national economies or regional economies? Would they be a problem instead? So what is the story around that? And why does it matter here? It matters because I don't know if you watched the thousands of people on the Champs-Élysées at the New Year Eve in 2023. They were all watching the Arc de Triomphe with their iPhone or Samsung phone. And somebody took a picture. So all of those screens, thousands and hundreds of thousands, all waiting the moment to capture the New Year coming and the fireworks. Now, all of those guys were working for free on the platform economy because they were adding value to the platform, they were using it to be relevant. So it can also happen that the way we measure productivity is not correct or consistent with what happens on the platform economy and with sandwich economics. So my question to you becomes, how does sandwich economics determine also the geopolitical competitiveness of countries? What do we have to consider to understand it, measure it, and build it for us?
Yeah, I think sandwich economics is increasingly going to shape how geopolitical competitiveness works over the next few years. And the reason for that is it's twofold. One is that we are seeing a small number of a small number of countries creating most of the digital infrastructure that the rest of the world is going to use.
Concentration.
Exactly. And a good example of that is what's happening with India Stack and many other public digital infrastructures that they're creating, which are now being used by other countries in the global south. Another example is, a country like Singapore creating port technologies that are going to be used by ports in other parts of the world. Before, the shift in strategy or lack of it over the last 4 years for China, so much of the 2010s, China's Belt and Road Initiative was also about exporting trade technology, exporting payments technology, exporting smart city technology and national identity technology to countries around the world. So what we're seeing is a systemic shift towards exporting digital infrastructure at scale and creating that infrastructure layer at a globalized level. And that, I believe is going to be the primary driver of how globalization happens in the next era. It's going to be less about which countries come together in bilateral agreements. It's going to be more about which countries agree on the common standards because of the digital technologies that they are using, which have those standards embedded in them. And so, yeah, sorry, go ahead.
No, they don't want to interrupt. Let's say the first time I worked in China was in 1999. It was an assignment by the World Bank to provide a credit training for the board of the City Commercial Bank of Nanjing. And that was the beginning of the second opening phase. And now we're at the beginning of the third. It's 20 years each. It always fascinated me, whatever is one's take, about how much the Chinese have been thinking platforms and digital economy, looking at what happens inside and outside. So there's something there that is relevant. But of course, there's not all is not all gold what glitters. Sometimes this generates also problems on a variety of fields. So the digital economy changes our relationship with society, with institutions, with government. So what are the negative effects that you see that are emerging through this shift on platforms to sandwich economics? And how can digital economies counter this negative effect? We want to make sure that while we understand this is coming, we know how to make it better than anybody else.
Yeah, I think one of the key aspects is that, and this goes back to also to some of the points you raised earlier about how you measure productivity, etc. But one of the key framings to understand the digital economy is to really think about in terms of where is value concentrating and where is value migrating away from. And what's happening because of the idea of sandwich economics is that value is increasingly, first of all, there's a shift in value from labor to capital, even more. So it's been the labor to capital value shift has been happening for the last 40, 50 years through a variety of mechanisms. But the current shift in technology actually accelerates that. A very good example of that is if most of us start getting augmented by AI, most of our most of the knowledge work starts getting absorbed into AI. It starts we as knowledge workers start increasingly getting commodified. AI is a self-learning technology, and so the more we use it, the better it becomes at absorbing that knowledge work. So at the bottom, you have an ever-improving infrastructure of knowledge work, which is AI. And then increasingly, as we get more commoditized as workers, platforms are better positioned to allocate work to us. A simple example of this is one of the most efficient platforms in the world. And I say efficient, I'm not saying it's the best business model, but it's highly efficient, is Uber. It always helps you find a driver close by. And the reason for that efficiency is that it has commoditized the driver so that the driver is fully substitutable. So you will always find a match. Versus in a platform where you have not had that kind of commoditization, where every worker is unique, finding a match may be more difficult, but it also helps you get more unique and relevant skills. But with Uber, what we see is with Google Maps, the advantage that cabbies had, that drivers had, it gets democratized. Anybody can now navigate a city using Google Maps inside Uber. And so if you extend that to the other extent and say, once knowledge work gets commodified, the way navigational capabilities got commodified into Google Maps, then most knowledge workers start getting increasingly commoditized, and they can be managed through centralized market making mechanisms the way Uber manages drivers. So if you combine centralized market making mechanisms at the top with increasing AI infrastructure, improving AI infrastructure at the bottom, you start seeing this increasing commodification of the worker and an increasing shift of value away to from labor to capital. And the McKinsey example is a great example of value shift from labor to capital. In the future of consulting, lower than consultants will go away, but or will be replaced by AI. But the ones who are who own the client relationships and who are willing to own the liability will gain outsized value. So we're seeing sandwich economics actually increasing the capital labor divide. And we're also seeing, the combination of centralized market making with increasing commodification because of AI at the back end, taking power even further away from workers. So that's really, one of the key issues that plays out.
Sangeet, as I said at the very beginning, the banker's bookshelf is there for the curiosity of bankers and fintech entrepreneurs. And you make me curious here. You pick my brain for a last question. Now, I released a month ago the 2024 Global Outlook for Banking and Financial Markets as the IBM Institute for Business Value. It's a work on AI, regenerate banking with AI. And there's an interesting data point inside this one about the future of work and the cultural transformation. Since 2016, we asked 3,000 executives what they believe is the most important skill set for the workforce. And we had a list of 12, STEM, and basic IT skills were number one, number two. Then down the line, you had things like time management and then creativity. I guess in a sense, many believe that engineers or STEM cannot be creative, and I don't believe there is a trade-off here. But we've been asking this consistently every year. And do you know what is the ranking in 2023 where STEM stands?
I think it's
you don't know?
much.
You haven't read the paper? I will send to you. Number 12th. The last position, and so basic IT skills. Creativity went up, not much. What went up is time management and prioritization. Now, there is a picture that is actually a dynamic picture, it's in flux. It's not that STEM is not important. I think that industries are realizing that the world that they live in, that became faster and faster, is very complex. And there's a lot of complexity inside them. As time management and prioritization went up, but they don't know how to prioritize. They don't know how to create the elements of value that can be shared. So basically, they can hire new talent or technology, but they can't perform because they're precluded from contributing and sharing value. Now, this is an issue of platform economies inside an organization to me, because did companies were capable of reorganizing themselves on a platform economy to allow people create units of value with their personal skill sets or with technology that can be shared, that is composable, that can be replicated in a way that can move forward. That would be essential. I think that your thinking also applies here inside the organization, not just outside in the way they conceive themselves, because they are ecosystem platforms in essence. So having said that, I think that AI might not replace workers. In some cases, it could happen, but it's people working with AI that will be able to advance compared to the others. What do you see in the future of work, thinking about the cultural implication of sandwich economics, to wrap it up?
Yeah, I think there are we will see in certain cases AI replacing workers. In certain cases, we'll see people getting better with AI.
Mhm.
In a lot of cases, I believe that we'll see people coexisting with AI, but losing the ability to charge a premium for their work, because a lot of the premium in their work relates to the knowledge that they have built over time. And if that knowledge becomes commodified, which means that a less trained worker can perform at the same skill set, a skill level as a better trained worker, then your training advantages start going down. So, we often talk about lifelong learning. What's going to be very important in the age of AI is, yes, you need to have lifelong learning, but what you learn is more important than just learning, because there are certain kinds of learning that are going to be commodified increasingly into AI, and there are certain types of learning which are not going to be. And so, understanding that distinction is going to be super important. And so, if I think of the impact of sandwich economics and AI on the future of work, there are three key points that I would share. The first is that when you think about sandwiching, the real sandwiching happens when you are stuck between two layers. And so the two layers are an ever improving AI infrastructure and a market making functionality at the top. Market making could be something like a marketplace like Uber, but even increasingly, internal HR job allocation in large companies is happening through internal market making technologies, where internal roles are being matched with internal capabilities. So as more and more market making of roles and skills happens through algorithms, you start moving into the sandwiching scenario. So that's one outcome that happens. The second outcome that I believe happens in the future of work that's going to be important is that AI is unique because, unlike previous technologies, AI is a goal-seeking technology. AI agents are goal-seeking. So traditionally, technology could replace tasks, but humans were still required to bring the tasks together and get the outcome. AI, with an AI agent, you can tell it the outcome and it can start reallocating and planning and learning from its environment to get the outcome achieved. So we get one step closer to removing agency away from workers. So second thing that I would look at is think about how AI agents impact you. Do they take away a part of what you do, or can you use an AI agent to create sort of a virtual team? In the sense that even if you are a single person, you could have an army of AI agents working for you. You could have your own organization, your personal organization. So keeping an eye out on that is I believe, going to be super important. That's the most interesting facet of AI, according to me. And the third piece, just to round this out, is essentially to kind of look at what are the factors that move closer to capital and away from labor. And some examples of that are relationships. If you have client relationships, that's one form of capital. If you have the ability to own liability in in an outcome, that is one form of capital. So what are those factors based on which you are not just charging for your skills or your talent, you are charging for the ability to guarantee something to your stakeholder? That becomes super important as more of your skills and talents get commodified with AI.
Sangeet, thank you very much for this conversation. I can tell you my view on AI here. I don't look at the Turing test to know if AI will effectively transform the world as we know it. I look at the capability of Microsoft to cannibalize itself and replace Excel. If that happens, that is really breakthrough on the world economies. But now, to conclude, how can the audience follow your precious work and what you build the most balanced foundations of sandwich economics? I'm sure that all the chapters in the world are also looking at you, and hopefully your immense IP is recognized. How can we all follow it?
Thank you, Paolo. I think I'm in the process of writing this book and bringing this idea out, and I'll be writing this in public at my newsletter, platforms.substack.com. So I'll be building up the ideas over there week on week, and that's one way to kind of see the idea evolve in real time until we get to a point where it comes out as a book.
I'm already there and invite everyone to go there as well. It's pretty interesting. Thank you very much. And thank you, everyone, for attending this first episode of The Banker's Bookshelf, which I remind you is our collective moment of critical thinking, inspired by authors and researchers of the most interesting books, papers, and publications, which are found in their space in the libraries of curious bankers and fintech entrepreneurs like Platform Revolution of Sangeet Paul Choudary.
Thanks for listening to Breaking Banks Europe, a Provoke Media podcast in cooperation with Fintech Stage. Don't forget to tweet us out, shout out, or post to the team at Breaking Banks EU on Twitter. If there's something or someone you'd like to hear on our cast, let us know. See you next week on Breaking Banks Europe.